But let's talk about Federal Bank. Horma spoke about it. We have Latha joining us in the studio to take forward the conversation with the management. Latha, over to you.
Thank you very much, Sonal. We are joined by Mr. Venkatraman Venkateswaran, the Group President and CFO at Federal Bank. Thank you very much, Mr. Venkatraman, for joining us. Just a word on the results itself. The NII has come in line with the poll, almost exactly in line with the poll. And the profit has actually surprised on the upside. It's a beat with a good 25% rise in profit. But shares sulking a bit, probably because, the margins are a little bit off. I mean, very little, really, just about 3 basis points lower. But NPAs have risen. After 14 quarters of reporting lower and lower NPAs, the gross NPA as a percentage of total book has gone up a bit, just 2 or 3 basis points, but it's still showing that NPAs probably have bottomed out. But all those questions to Mr. Venkatraman, thank you very much for joining us. Well, first up, if you can give us some basic numbers, how much has the cost of funds risen over the quarter?
Good afternoon, Latha, and good afternoon to all the viewers. Thank you. To start with, I'll say it's been a fantastic quarter in terms of the bank achieving its 4-digit net profit number for the first time, over 1,000 crores. Credit costs well contained. It's within the guidance which we had given. Cost-income ratio sequentially lower. So overall, I would say it's been a good quarter. And to your question about cost of deposits, Latha, where it was about 20 basis point increase between last quarter, where we have seen. And what we are continuing to see is the pressure on deposits continues. So the pricing hasn't eased as such. So we continue probably to see same levels of deposit pricing in this quarter as well.
But how much will you be able to pass on? It looks like this time you've passed on mostly, but are costs likely to increase even more? Do you, at the end of the fourth quarter, will you tell us that deposits are another 20 basis point more expensive? And therefore, what margin guidance can you give?
Very unlikely at this stage, based on current liquidity conditions, and very unlikely we'll see another 20 basis point increase. At the same time, we are trying to see how much of this can be passed on through the asset pricing. Guidance for NIMs at this stage, I would say that we'll stick with around the same 320 levels. I don't expect NIMs to improve nor deteriorate significantly from the current levels.
Got it. Let me now come to the Reserve Bank's new rules, the unsecured loans. What was your percentage of unsecured loans at the end of the third quarter, at the end of the second quarter? What is it now? And can you give some guidance on that when you want to bring it down even further?
Sure, Latha. And as you know, in our case, the unsecured as a percentage of the overall assets is a very small percentage. It was at about 4% end of Q2. End of Q3, it's 4.6%. In unsecured, I'm including MFI, credit cards, and personal loans, all three put together. So it's even less than 5% at this stage. And even if we continue to grow it at a much higher pace, given that the base is small, we don't see this being impacting us significantly going forward. But having said that, the Reserve Bank obviously asked banks to set aside higher capital for the exposures to unsecured and NBFC, which we have taken into account, and we have done that.
Okay. Well, actually, to speak about that, you mentioned that it is a satisfying quarter, certainly satisfying from an ROA point of view. It's a 34-quarter high, the return on assets at 1.4%. So that's a significantly higher performance. But ROE has slipped a bit by about 100 basis points, is it? To 14.8. I think the last we heard was 15.9. Isn't that right? So is this, what does this point to, Mr. Venkatraman?
See, the ROA, like we have been guiding, Latha, we want to make sure we sustain the growth. And over the last 8-10 quarters, it's been a steady performance as far as ROA is concerned. And if you had noticed, we raised the QIP in Q2 and the IFC pref money came in Q3. Usually in the quarter in which there is a fundraising, there will be a bit of softness on the ROE.
Fair enough.
That is what we have seen now. It's not 100 pips, it's about 40 pips movement between...
no, that's... yeah.
Quarter on quarter.
That's right. Quarter on quarter, yeah. Quarter on
Yeah,
quarter, I think it works to about 90 bips, yes.
Yeah, 90
Mr. Venkatraman,
But yeah.
yeah. No, I just wanted to build on that. What has been the credit cost?
See, the credit cost for this quarter has been 31 bips, Latha, and last quarter was 13 bips, which we all knew was unusually low. We did say that normalized 35 to 40 bips is the full year guidance. Q3 was 31, and we expect the year to be within the guidance which we have given, around 35 bips. Now, specifically I did see the thing about slippages. I do want to make a point about that because I don't think it's correct to look at these slippages just on a quarter-on-quarter basis. May not give the correct picture. If you look at, let's say, 1% of the book as slippages for the year average, so let's say 1,800 crores. For the first 3 quarters, we are around 1,300 crores. So we are broadly in line with that. Will be less than 1%. And this particular quarter, there was one corporate account which slipped. Good business, well-known promoter. There was a fire in the factory, which caused the disruption. They were servicing the loan through GECL, but after that they couldn't. So that was the reason why it's a one-off lumpy number which has come in slippages. And we are reasonably confident that this money will come back in Q4 because they've already tied up with some investor for funding, and we will get repaid. So it's just that one particular account which is kind of optically showing that slippages has moved up. If you exclude that, we are pretty much in line. And even with that, we are still well within that 1% slippage for the year.
Okay. Well, actually, that was going to be my next question on the slippages being 30% higher, but you answered that. Thanks for that. Let me come to OPEX. I mean, why is it that much higher? 27% a bit unusual, and even employee cost quarter on quarter about 11% higher. Is there something we should know?
See, in staff costs, Latha, we have increased the provision for the wage revision, which is likely to come. Last November onwards, we were providing at 15%, and in Q3, we got to know that the rate is going to be much higher. It's around 17%. So we did have to catch up for that in Q3. So that's the reason why the staff cost has gone up. And secondly, the spends on IT, and this is a 2-3 costs. One is IT, the other one is branch expansion. We have added about 65 branches in the first 9 months. And there's obviously the cost gets upfronted. The other data point on the branches, which I would like to share with you, is last year we opened 75 branches, of which 41 have already turned positive. In the sense, in less than 1 year, it's break even. This is something which we have seen improving over the years. It used to be 2 years, prior to that even more than that. The fact that we are able to choose the right location, get the business, and see the branches turning profitable is a healthy sign, which gives us confidence to invest more in the branches. The next reason for the cost increase is investments in IT, which is something which we continue to do, whether it's cybersecurity, compliance systems, audit systems. There are a lot of
actually on that,
to be put in place.
Sir, actually on the IT expenditure, the governor said in the press conference itself that he wants banks to spend all the money that they allocate for IT. He often finds that part of it is not spent. So should we expect this OPEX to continue because of IT spends?
It would be in the similar levels, Latha. In terms of OPEX, we will continue to invest, and we believe these are the right investments to make. Given the fact that we are growing in size as well, we are now 4.5 lakh book size, and fairly big in the next to the top rung banks. So we have to make sure that the ecosystem guardrails are in place, and it should be compliant growth, which is the focus of the bank.
Okay. Now for the most important number, what kind of a credit growth are you expecting for the full year? And the added caveat, did you hear from the Reserve Bank on credit deposit ratio? Even y'all are pretty tidy at about 84%, isn't it, your credit deposit ratio? Did you hear
it's
from
about
them?
83.
Okay.
Yeah, it's about 83. And yes, that's a message which has come to all the banks, and we will be working through that in the subsequent quarters. So we should keep in mind that if it has to come below 80, what are the adjustments we need to do? Obviously, we would love to get the deposits growth much higher and continue to be growing the advances because we don't want to let go any good credit. In terms of growth, we continue to stay with the guidance which we gave, 18 to 20% growth for the year.
No, I mean, that just to wind up the conversation, if you have to bring down your credit deposit ratio and you want, to keep your credit growth at 18 to 20%, deposits are expensive. The Reserve Bank's liquidity policy has not changed. So won't something give? Either you're not able to grow volume so much or your margin has to, you have to accommodate a lower margin. You don't see that happening?
No, it's a fine balance, and of course we have the option of trimming the tail and making sure we don't write advances where it's, not meeting our threshold in terms of yields. So we probably have to be taking some more measures to make sure that all the new bookings are at a particular yield level, try and grow the high yielding book much faster. And at the same time, like you said, deposit pricing hasn't eased as yet, but we never know how it will move in the next few months.
Okay, yes, it's quite possible that with the lower inflation number, the Reserve Bank relents and the Fed also relents, but we don't know. Thank you very much, Mr. Venkatraman, for joining us with all those details. And once again, congratulations on an excellent ROA number. I'm sure the market will want to react positively to that, but at the moment, it's a little more preoccupied with the NPA and the slippages number. It's been explained, though. Back to you.
Okay, all right. Thank you, Latha, for that conversation. That was Federal Bank, the stock on our radar on the back of numbers. With that, we'll sip into a short break and get you more on the markets and stock-specific action on the other side. Stay tuned.